Good afternoon and good morning. Welcome to the Charlie Mike webinar series sponsored by the National Veteran Small Business Coalition. Thank you for joining us today. This webinar is made possible by BAE Systems and Philips North America. We'd like to thank them for their sponsorship. Just a few announcements. The NVSBC Educational Federation Golf Tournament is on Monday, August 22nd. Please join us in Arlington, Virginia at the Army Navy Golf Club and just meet with your fellow veteran small business owners and some federal agencies, and we'll have a big networking lunch right after the golf tournament. So please come and join us. I will send you a link to the golf tournament, and just in case you want to play and place a bet. And again, we are having our first annual awards gala on September 13th from 5:30 to 8:30 at the Army Navy Country Club again. They're welcoming us back. Our nominations are now open. If you'd like to nominate a federal agency or a prime contractor for the Small Business Advocacy Award or Gordon Mansfield Award, we accept nominations until July 15th. So please come out and join us for that event as well. Okay, this webinar is an hour and 15 minutes. It's being recorded, and the recording and slides will be sent to attendees by Friday. If you have any questions during this webinar, please type on the right hand of your screen on the control panel. You guys should know me already. I am Earl Morgan. I am the program director for the NVSBC, and I would like to welcome our good friend, Alex Mikhelson, CPA. He's the senior manager of Baker Tilly. So please welcome Michael to learn about accounting. And believe me, when I heard about this topic, it reminded me of my college days, and I hated accounting. So hopefully I get to learn a lot as well. So Michael, the floor is yours.
All right, Earl. Thank you. Let me, I guess, can I share my screen here?
Share screen with you.
All right.
2, and there you go.
All right, let me try that here. Did that work?
That should work. Yep.
All right, awesome. Sorry, I got the webinar screens up here. So bear with me here. For those of you that were able to have off yesterday, like I was, it's Monday for me. So, all right. Thanks everyone for joining in. As Earl said, my name's Alex Mikhelson. I work with Baker Tilly. We're we've now, through a series of mergers and acquisitions, we're now one of the top 10 accounting firms in the country. We actually have an international presence through our partner network. We're full service accounting, tax, audit, but I work in a very niche area that's helps advise and provide services to government contractors. A little bit about myself. I started my career as an auditor. I like to say I have since been reformed, now a consultant, but I did 7.5 years working for the Army as an auditor, did about 3 years working for an agency called DARPA, you guys may have heard. I was a contractor for them, working on the business process side, the accountable property side of things, financial improvement, audit readiness, all that fun stuff. And I've been with Baker Tilly for about 6 years now, helping government contractors, all shapes, all sizes, with various aspects of the government contracting sort of life cycle, everything from proposal support to indirect rate structures, business system reviews, accounting system being one of them that we'll talk about here. Audit support. We get a lot of referrals from lawyers. Usually it's because there's some issues. Clients don't necessarily know how to handle them. That's where they sort of come to us for help. But that's enough about the sales pitch side of the house. I really excited about this topic because when I first started working with government contracts, this topic confused the heck out of me as well. And we're dealing with accounting system reviews, and we hear, topics like acceptable, adequate, approved. What the heck does it mean? What do we got to do? And that's kind of what I want to drill down into with this presentation. Earl mentioned that we're here for about an hour and 15 minutes. Maybe not. We'll see how our discussion goes. But please feel free to put your questions in the chat. Hopefully I'll pick them up. If not, maybe Earl can chime in with some of the questions and we can have a discussion there. So this was me many moons ago. Like, what the heck are we talking about? You know, we're responding to an RFP, and there's all these terms we'll see: adequate, approved, acceptable. You know, contractor says should be adequate, this should be acceptable and approved. What the heck does all this mean? Unfortunately, a lot of times you'll hear these terms and people use them interchangeably. But as we'll see throughout the session here, they do have actually very specific meanings, and they mean very specific things, right? And there's certain circumstances that you'll encounter some over the other. We'll also talk about some best practices with accounting system. We'll touch on, you know, when there is an accounting system requirement in your contract or in an RFP that you're looking at, what are some of those elements? We could do an entire session on just what the government looks for in an accounting system, but that's probably going to be a topic for another day. I really want to get a good understanding of what these various A's are. And then throughout the session, you'll see, you know, we had a little tag of compliance hacks. They're kind of like tips and tricks, or just sort of words of wisdom, best practices, things that you guys can take away from the session itself. All right, so here's the three high-level topics we'll talk about. We'll talk about what's adequate, what's acceptable, what's approved, you know, where do they come from, and what do they mean. So let's start with adequate being the first one. So it all starts out with FAR Part 9, specifically 9105, and it's a contracting officer's requirement to make a determination that a contractor is responsible. What does that mean? Well, they can they have all the information, they have all the technical knowledge, the financial capabilities to basically perform this contract, right? And the contracting officer is going to use all information that's available to them to make that sort of determination. That's our first box, right, to award a contract. Now, if we're dealing with an other than fixed price contract, the contracting officer must determine the adequacy of the contractor's accounting system. This is where the term adequate comes from. How do they do it? Well, it's up to them, frankly. For an adequacy determination, the contracting officer is going to use whatever cost data, whatever information is available to them to make that determination. Real easy. We all know government contracting is never easy, but on the surface, when it comes to an adequacy determination, it's really up to the CO. Some of you may have, if you've dealt with cost reimbursable contracts, you know, sometimes you'll see contracting officers come in, they'll request a pre-award survey, which we'll talk about in a minute here. So that's one of the tools that they'll use to make that sort of adequacy determination. But that adequacy determination is basically made prior to award. Okay. So this is where we see some of the tools that a contracting officer would use. There's a pre-award survey that's spelled out in FAR 9106. There's a package, it's called an SF 1403, which has all sorts of checklists and forms that the contractor can use to fill out to help get to that responsibility determination that we talked about. Part of that package is this SF 1408. It's this standard form 1408. And this is what many of you would see when it comes to a pre-award survey. There's criteria in there that it's usually not the contracting officer that fills it out. It's usually an audit agency like DCA that'll come in and they'll take a look at your, it's more of a design review. They'll take a look at it and say, hey, do you check the boxes or not? Usually it's only required when the information on hand that's available to the contracting officer isn't really sufficient for them to make that sort of determination of responsibility, which that's a broad requirement, or rather They have a lot of flexibility there. So a lot of contracting officers, of course, depending on the contract, will default to this pre-award survey, the 1408. So the question is then, well, when we're looking at the adequacy determination, if we're compliant with this SF 1408 form, are we truly adequate? Well, no. If you look at the form itself, as Holmberg's helping us out here, the 1408, compliance with the 1408 states that your accounting system is acceptable. All right, so that's that second A that we were talking about. So when it comes to adequacy, it's really the CO's ultimate determination. So this form, if they were to use it, if they were to have DCA come out and fill it out, all it would say is, Mr. Contracting Officer, this system is acceptable. Based on that information, based on a whole other factors that the contracting officer has, then they may make that determination that your system is adequate. I promise this stuff's going to make a little bit more sense in a minute here. So here's our first hack. When we're looking at the A, our session, right, is the straight A's, adequate, acceptable, approved. It's the contracting officer's prerogative on whether or not you get that A, period. That's the only person that can make that adequacy determination and award a contract to you that's other than a firm fixed price. So when we're looking at the various A's of the accounting system, right, let's look at some of the individuals involved when it comes to reviewing our accounting system. So up in the left-hand corner here, we have the DCA, which is the Defense Contract Audit Agency. They'll do the pre-award surveys at the contracting officer's request. That's that form 1408 that we just looked at. The CO may request that they come in and do a post-award audit. One really looks at the 1408 really looks at your design of your system. The post-award audit will actually do some testing. It's a little bit more in-depth to make sure that your accounting system actually meets the criteria and is acceptable. The key with DCAA is they usually work at the contracting officer's request. So we as contractors, for example, cannot call up DCA and say, hey, I need you to come review my system. They won't do it. They're the technical advisors to the CO. The contracting officer is ultimately their customer, even though most of the time they'd spend with you guys. On the right-hand side, you have DCMA. It's the Defense Contract Management Agency. So they do a lot of different things with contracts. They administer a lot of contracts, not all. So they do the day in, day out sort of administration work. But when it comes to the accounting system, really all DCMA does is they populate, update, and maintain the data in CBAR, which is the Contractor Business. I have the acronym spelled out on a later slide, but it's basically the system where they track the status of contractors' business systems. Bottom left-hand corner, you have third parties. So, you know, I said earlier that a DCAA won't come out and look at your system because they work at the behest of the contracting officer. Section 893 of the 2017 National Defense Authorization Act does contemplate and does allow third parties to come out and conduct business system reviews. However, that case in the DFARS, the Defense Federal Acquisition and Regulation Supplement, is still pending. So what that basically means is while the law allows for it, it hasn't really been operationalized into something that we can actually use and contracting officers can rely on via the regulations. So while it's allowed by law, third-party reviews of your accounting system, your other business systems, there's no mechanism for a contracting officer to accept that. Now, does that mean that they're not valuable or not relevant? Well, no, right? Because remember, to one of our first slides, the contracting officer can use any information that's available to them to make that adequacy determination. So third-party reviews, if you have a consultant, an accountant, whatever it is, come out, take a look at your system, fill out that 1408 and say, hey, acceptable. And you provide that with your proposal. There's no guarantee and there's nothing that requires the contracting officer to accept that. Not yet anyways, right? That DFARS case is still pending. But it is a piece of information that they can use to determine whether or not your system's adequate. Maybe they may look at it and say, hey, I don't need DCA to do this. This looks good. It's all cross-referenced. They're supporting exhibits, so on and so forth. NASA does allow contractors to use audit services when DCA is unable to perform. So there are other agencies that do that. DoD right now doesn't really do that. But it could also give you some insights into where your accounting system may actually be deficient, or maybe you can make some improvements before the government actually comes in. And then bottom right-hand corner, the big green one, again, just to reiterate, your contracting officer and your administrative contracting officer, these are the people you ultimately need to convince. Everybody else sort of plays a role in being an advisor and prepping sort of tools and things like that. But the contracting officer and the ACO, these are the ones that really are the ones you need to convince. And again, they have the ability to use any information available to them. It could be an audit report, other information. So it's good that they're the ones we need to convince. But again, depending on what we give them, it can kind of go both ways. All right, so adequate, we've figured out it's whatever the contracting officer determines is adequate. It's up to them. It's their sort of prerogative. That's who we need to convince for adequacy. That's what adequate means. It's the contracting officer's determination. Now, acceptable. We sort of touched on it a little bit, right, with the 1408. When you look at the form, it says, hey, it's when you prepare this checklist, there's a determination made whether or not the contracting, when the contractor's accounting system is acceptable. And that's all well and good, unless you have the DFARS clause at 252, 242, 7006. That clause typically is included with the 7005 clause, which talks to business systems in general. And the 7005 clause, you really don't have to worry about it unless you have CAS, cost accounting standards covered contracts, which given our group here may not, we probably don't have a lot of folks that have CAS covered contracts. But if you do have this clause, there's 18 accounting system criteria versus the 15 that are spelled out in the 1408. And for the most part, they say the same thing, but just being aware that, if I'm responding to an RFP that has a 7006 clause, simply doing the 1408 may not be enough to convince the contracting officer, because this 7006 clause is in there and there's some additional criteria. So what's the difference? So there's a third piece that we haven't talked to yet. It's the DCA, the Defense Contract Audit Agency pre-award survey checklist. These are things that they look for, criteria that DCA looks for when they come in and do that pre-award survey. And they all sort of, if you picture a Venn diagram, right, they all have the exact same criteria in there, with the 1408 sort of being the center point. But DCA looks at previous audits that have been performed, obviously CAS coverage, and they'll look at your disclosure statement if you have CAS coverage. For those of you that aren't familiar with the disclosure statement, if you have CAS covered contracts, you have to disclose all your accounting practices, the makeup of your direct and indirect costs, the makeup of your indirect pools and bases, things like your overhead rates, your G&A rates, your fringe rates, so on and so forth. And they'll take a look at whether, how much cost type work you have. 1408 criteria specifically deals with compliance with generally accepted accounting principles, looks at how your accounting system segregates your costs, segregates direct from indirect costs, how you accumulate and allocate those costs, looks at your labor distribution. So when our folks charge through the timekeeping system, right, costs to they charge 8 hours one day, 10 hours another day. How does our system allocate which contracts that goes to? Maybe it doesn't go to contracts. Maybe it goes to overhead or G&A, but looks at the process there. And also, how we treat allowable and unallowable costs. That's sort of the crux of the 1408. The 7006 criteria in the DFARS goes a little bit further. It looks at the makeup of internal controls. It looks at how your accounting, how you do reconciliations from your general ledger to your subsidiary cost ledgers, how you handle adjusting entries, what sort of internal reviews you do, how you handle billings. So it's sort of like a 1408 plus, if you will, when you're looking at the criteria across the board. But again, they're all very similar. And so I won't go through these line by line, but this is a comparison of the 1408 criteria and the DFARS criteria. Again, we're talking about acceptable accounting system, right? This is what you need to have. And you can see some of the overlap. You'll see some of the areas where there's additional DFARS criteria that aren't necessarily spelled out in the 1408 criteria. And so when DCAA comes out and they do that pre-award survey, they'll look at the 1408 criteria. Usually when they come out to do like an accounting system audit, they'll start looking at the DFARS criteria, because with the DFARS criteria, especially that very first one, there's a call for having a control environment, framework, organizational structure that provides areas for DCA to actually be able to test and look at specific transactions. This is just a continuation of the 1408 versus the DFARS criteria. I promise I won't go through them line by line, but give you a sense of what they are here. And again, Earl's going to send the deck out so you guys can have you'll have all this to reference if there's specific questions around it. Okay, so we've covered adequate. Adequate is simply the contracting officer's determination that your system's adequate. Acceptable is basically our accounting system meets the criteria either spelled out in the 1408 or the 7006 clause in the DFARS. All right, so what are we talking about when we say approved? Well, we got to use a little bit of math here, and I swear I did this. It's a little bit of a joke, but what we're really looking at is, to get an approval, we have to have an acceptable system, and we got to look at the inverse of disapproved. Why? It's frankly, it's just the way the clause is written that we'll look at in a second here. So the DFARS, neither the FAR nor the DFARS define what an approval is for a business system, including the accounting system. What they do define, and hence the inverse of disapproval, the inverse of disapproval is they define disapprove. What does it mean to have a disapproved system? And all that really is contracting officer providing initial determination in writing that there are significant deficiencies. So there's a letter that we'll get that says, hey, we have big problems that that we have to fix. And if we don't fix it, the contracting officer can make a final determination to disapprove. And of course, with that 7005 clause that I mentioned earlier, that's the business system clause. If we're CAS covered, there may be withholds and things like that. But based on this definition, we can infer that, if disapprovals have to be in writing, that approvals also have to be in writing. And this is confirmed when we look at the DCMA manual 2301-01, which again, that's applicable to DCMA. That's our own internal manual, internal instructions, but it gives us a little bit of insight into how DCMA works. All those manuals, instructions are really good to figure out, hey, if you ever have that question, well, what is DCMA going to do with this information I give them, or what is the process? Their manuals, their instructions, most of them are available on their website. Will give you a good insight. But we can see that if the ACO, and this is sort of the counter to that, to the 7006 clause we saw, if the ACO determines that no significant deficiencies exist within the business system, the ACO must issue a final determination within 10 calendar days of receipt of the business system report. And the final determination will notify the contractor that the business system is approved, right? So that's what the approval means. It means that we get it in writing. So really the only A that matters throughout this whole process when it comes to having an approved system is that quote unquote A that the CO issues on his or her letter. And you kind of hope it's an A, not the D, the disapproval, right? So again, just to recap, adequate is the contracting officer's determination that your accounting system is good for award of cost reimbursement contracts, or rather, I shouldn't say cost reimbursement, I should say other than fixed price, because for T&M, time materials contracts, there is an aspect there too. Acceptable means our system is compliant with the SF 1408 or the 7006 clause, depending on what's in our contract. And finally, the approval is what we get in writing at the end of the day. And that's the A that goes into CBAR, which is the Contractor Business Analysis Repository. I told you I had it on a slide. And what happens is you get the letter, and whether it says, the letter may sometimes say adequate, acceptable, or approved. I mentioned earlier on that people use them interchangeably, and I don't like for that because it causes more confusion. But when all said and done, what gets into CBAR is either approved, disapproved, not evaluated, or not applicable. So it doesn't really matter what the letter says. If you get the letter and the contracting officer says, hey, you're approved, or you're adequate, or you're acceptable, and it's signed, and that's what goes into CBAR, you have an approved system. Okay, so now let's talk a little bit about, all right, what is an accounting system? What are we talking about here? The first tip here is it does not have to be complicated, right? You don't have to have an overly complicated and overly elaborate accounting system. I have to be careful when I say, you can have an acceptable accounting system even if you do it in Excel. Whether or not you want to, but it can be done. I've seen it done smaller shops, as long as you can hit all that sort of criteria. And in a nutshell, what are we looking for when we're looking at accounting system? It's really all about making the pieces fit, right? Putting things in their right buckets. We want to be able to identify allowable and unallowable costs, identify direct and indirect costs, accumulate our indirect costs. We need to be able to segregate direct from indirect, allowable, unallowable, allocate the costs where they need to go. We need to be able to have sufficient data so we can estimate costs, especially for follow-on work, and we have to be able to report it. So what the government's really looking for is that you're not square peg round hole when it comes to costs, right? So we're not going to have costs that we did where we worked specifically on a contract. We're not going to put that in an overhead. We're not going to consider an overhead cost, and vice versa, right? We're not going to have overhead costs that we're charging directly into a contract, right? Those usually go into an overhead pool. They get accumulated there, and then they get allocated across a certain base. And that's true whether or not you have you're covered by cost accounting standards or not. That's just typically the nature of indirect costs. And again, we can do a whole session on direct versus indirect costs, how we accumulate and allocate. But I figured that might be a little bit of overkill for this session here. I just kind of want to get the lay of the land on what we're talking about when it comes to accounting systems. And ultimately, all this goes into is ensuring, again, we're talking cost reimbursable work, where the government's paying its fair share of costs. So all this helps ensure that the government only pays for its equitable and allocable share of the contractor's business expenses. Pull the thread a little bit more, protecting yours and my taxpayer dollars that ultimately go into funding a lot of these efforts. So when you're thinking about an accounting system, consider the KISS concept, the keep it simple. We all know what that last S means, right? Having a complex accounting system can actually be a hindrance. What do I mean? Well, if we have complications, right, they tend to increase the number of control points. If we have 5 or 6 different reviews before we approve a requisition, for example, before we can buy something, even though the purchasing aspect of it is a purchasing system, right? The requisitions usually originate from the accounting perspective, right? There's a need, we prepare a requisition, whether it's paper or account or in our system if we're a little bit more advanced, goes to accounting, make sure we have enough funds to do that, so on and so forth. So if we have 5 or 6 different review points, well, that's 5 or 6 different points of failure. Somebody didn't review it, somebody didn't look at it, right? and whenever we have the increased potential for failures, right, we have an increased audit risk. What is audit risk? Well, it's when auditors come in, they look at something and say, I'm not really sure that, you know, this is as simple as it is, or there seems to be a lot of potential for failures or breakdowns in the process. I'm going to dig a little bit more. I'm going to test more. That's what we're thinking about when it comes to audit risk. And so when we increase audit risk, the auditors tend to have more scrutiny. They tend to test a little bit more. And when we're thinking about complications, DCA, the Defense Contract Audit Agency, actually has a separate audit program for major contractors. They usually define it in terms of dollars, as you can see below here. But they do it because they consider the entities to be more complex compared to the audit program for non-major contractors. So you'll see more steps, more testing, the more complex the system is. You know, a lot of this is kind of like it's finding the right balance based on, you know, our business, what we do, what we sell, what our contracts say, and balancing that with, okay, how many control points do we need? How many reviews do we need? You know, how much can we segregate duties, right? If we're a smaller organization, we probably can't segregate duties all that well, and that's understandable, that happens. But if we're like a major defense contractor, you know, we have departments to do everything, and that, of course, you know, is a balancing act. So part of it is really it's understanding what's appropriate for us. Another common mistake that I've seen, and people talk about, you know, oh, we bought this software it's DCAA compatible or DCAA acceptable, or it's DCAA approved, so on and so forth. DCAA never approves a particular piece of software. So the key here is you don't buy an acceptable or approved system off the shelf, not without a little bit of a assembly first, right? Because when you look at an accounting system, and this is true for any of the other business systems that, for those of you with the DFARS clauses that you're looking at, it's really a combination of many things. It's our transaction cycles, right? What does our business do? What's our billing and our accounts receivable? What are our policies and procedures say that we do, right? Because that's what DCA, that's what the reviewers are going to be looking at, is what do we say we do versus what we're actually doing. There's potential for self-inflicted wounds there, right? That ties into the processes and controls. What are we actually doing? Who's involved? And then the software, the tool that we use. So that software box that people often say is, oh, I bought a DCA acceptable accounting system. Well, you really didn't. It has the capability to be acceptable and meet all the criteria that we talked about. However, it's your transaction cycles, your policies, procedures, process controls, people. People, procedures, technology. We usually say that's what it is. Is what makes the system, right? So really, the accounting system, when you boil it down, it's the manifestation of your business processes. Depending on how complex your organization is, you may have touch points to other like purchasing systems, estimating systems, government property systems. There's all sorts of considerations, and it can get pretty complicated the bigger you get. But just keep in mind, you have to, you don't buy something that's acceptable or approved off the shelf. There's always a little bit of assembly required, right? So we talked about most of these points, right? DCA doesn't recommend, nor does it approve any specific accounting system, vendor, or software packages. This is the packages that you see that claim to be approved, meaning they have to have the capability to do it, right? You still have to implement it, and implement it in a compliant way, right? Not just flip the switch and start throwing data in there. There has to be controls, processes, flows, procedures to make sure that it's good to go. There's plenty of third parties that specialize in implementation, but again, if you're going down that route, I'll throw it out there that, I mean, one of the most popular ones is Deltek Cost Points. It also happens to be one of the most expensive ones. There are plenty of third parties, including Deltek itself, that does implementation. But many, I won't say many, I shouldn't say that, that's not fair. We've seen third parties that come in to implement like a cost point, for example. They look at your IT controls, they look at your network capabilities, your hardware capabilities, and then they give you a basic setup and you're good to go. And we found contractors that'll come to us and say, hey, we did this a few years ago, it's not really working for us. They never kind of thought it through. Can you guys redo it? So make sure when you are buying software packages that you understand that it's it's not as simple as just flipping the switch and turning it on. There's people, processes, technology, all that sort of needs to work together. And you want it to be what's right for your organization. You want it to be flexible and scalable as you grow, and also be compliant. So make sure that whoever you use, they understand it's much more than just installing software. Okay, so back in the beginning of the presentation, right? We talked through adequate, acceptable, approved. You don't always need an audit for approval. You don't always need an audit for acceptable, right? Consider the 1408 as a starting point. So what am I getting here? Well, when you look at your entire system, right? The very basic criteria that most DCA auditors, most contracting officers, frankly, will look at is the 1408. Is how is my system designed to meet those 15 criteria that are spelled out in the 1408. Some contractors do it internally. They take the checklist and they say, okay, can we do this? Can we do this? Can we do this? Can we do that? Can we do this? Some hire a third party to do that. All that's fine. Keep in mind, again, the third party reviews don't necessarily guarantee that the contracting officer is going to give you guys an approval. However, the contracting officer, again, makes that adequacy determination. They're allowed to use whatever information is available to them. So if you were to do your own 1408 or hire a third party to do the 1408, and it's very well supported, right? Yes, the 1408 is a one-page checklist, or 2 pages when you consider the header. Is that really it? No, there's a lot of work that should go into supporting each one of those yeses when you check them off, right? So it's kind of putting together a package. Do we segregate direct and indirect costs? Yeah, sure. Here's what our policy says. Here's an example, right? There's all sorts of things that can go to make that 1408 a more robust product. DCAA, when they come out and they do a 1408 review, they do it under that 17740 program. They look at the design effectiveness. How is your system designed? There's no transactional testing. They're not going to go out and say, okay, now is this working? They may do some walkthroughs and observe how things work. They may inquire of personnel. They'll do interviews and say, hey, how do you do billing, or how do you handle unallowable costs? They may look at relevant documentation like your policies and procedures. They may look at your trial balances. They may look at some ledgers just to see some of what's in your procedures in action. Again, they're not testing the validity of those transactions, just looking at the design. And it's not really necessary for a 1408. Again, it's usually pre-award. So like I mentioned earlier, the evidence piece, right? Don't just complete the checklist when you're doing it, if you're going to take that route, versus waiting for the contracting officer to say, hey, DCA, go look at these guys. If you've already done some of that legwork and it's really well supported, and we can demonstrate that our accounting system design is compliant, sometimes that could be enough to convince a contracting officer. I've seen it. However, contracting officer may still send DCA out to look at it. Well, if DCA does initiate, hold their hand. Auditors are really smart people. I used to be an auditor. However, if you let an auditor roam free, that's exactly what they're going to do. They're going to start looking around. They're going to start digging and digging and digging. What you want to do is you want to hold their hand. You want to guide them, right? You can't force them to get to the conclusion, but you can certainly guide them to, here's my documentation. annotate things, right? Here's what I want you to look at. If it's something that takes you a couple of steps to calculate to get to the answer, spell that out, explain it to them. If there's something that's unique to how your business runs or how your accounting system runs, you want to make sure that you get that in front of the auditors. And I tell all my clients this: if there's something wrong, it's always better that we self-identify it and come up with a plan to fix it, versus not bringing it up at all, knowing it's wrong, and then having the auditors find it, and then it ends up in an audit report. So when an audit report says all this was broken, hypothetically speaking, versus the contractor identified that this was broken and here's their plan to fix it, and we're going to come back and test in 6 months. Which one of those reads a little bit better? The second one, of course. So pre-award survey is one of the best ways to get a feel for how's our accounting system doing relative to what DCA or what the contracting officer is going to be looking at. And in certain situations, if it's well packaged, well put together, and submitted with a proposal or submitted to a contracting officer, it may be enough to convince them that, hey, my system is adequate and we may get the approval and we don't need an audit. Again, not guaranteed. Okay, if we do get the audit, right, sort of building on what we talked about, if DCA does initiate an accounting system audit, part of the things we need to do as contractors is understand our risks, know where our problems are, and help lower those risks. Because, excuse me, let me go back to the slide. Because when we know our risk, when we can take steps to lower our risk, and we can show that to auditors, it helps lower their perceived audit risks. Sometimes if auditors know there's a particular problem in a particular area, but you have a plan to address it and fix it, they probably won't even test there because they're going to get to the same result. So sometimes there's benefits to self-identifying things. This is a graphic that we use quite a bit for assessing compliance risk, right? There's two factors here, right? There's our policies and procedures, and then there's our practices. So policy and procedure, we're looking at, what's sort of in our design, and the practices, we're looking at what are we doing on the ground. And ideally, of course, you want to have practices that are compliant, but you also want to have policies and procedures in place. In the yellow areas, you'll see the split of those two, where we have practices that are compliant. We know what we're doing, but we have no procedures in place that talk to that or mimic that. And the risks there always are, right? We have our controller, for example, or our CFO, and they know exactly what we're doing. They have all the knowledge. Well, tomorrow that CFO retires or takes another position, or God forbid gets hit by the proverbial bus. Now what do we do, right? We're talking really continuity of operations. Now we have no procedures in place to tell us how we did any of this. It's very difficult to recreate all that institutional knowledge. So it's not only just having policies and procedures in place for the auditors. It's also important for our own organization. Vice versa, right? If we have policies and procedures in place, but our practices aren't compliant, I think that's probably even worse. And I should probably color that a little bit more orange than yellow, because we say we're going to do all this stuff. It makes sense, but we're not doing any of it. That probably looks a lot worse than doing the right things and not having procedures to back that up. And of course, in the red, none of our stuff's compliant, not our practices, not our policy and procedures. And that, of course, is the highest risk. All right, so how do we deal with that A? How do we get that A in the accounting system, right? In that audit? Well, we have DCA's cheat sheet. It's audit program 17741, or if we're a major contractor with the more complex systems, it's the one I mentioned a few slides ago. I apologize. I can only memorize a certain amount of things here. But the audit's going to focus on the operation, not just the design, right? They're going to go out and they're going to test transactions. We say we do billing in 30 days. They're going to go out and they're going to take a look at our billings. Did we do everything every 30 days? It's looking at detailed internal controls and transactions. We're going to be testing a lot of that. So how do we get the A? Well, again, it's know thyself, know what your accounting system is, have your policies and procedures up to date, and make sure that they reflect what you're actually doing. I can't tell you how many times I've seen those self-inflicted wounds. We say in our policy procedures, we do X. We give those policies and procedures to the auditors. The auditors read and say, okay, doing X makes sense. Let me see X. And they go and test transactions, and all they see are Y's and Z's. And they'll write you up for that. And then depending on the materiality or how quote unquote significant it is, that they may give you some findings, and that which may be less than desirable. Organize your policies and procedures around your major business cycles. So here's what we do for accounts payable. Here's what we do for accounts receivable. Here's what we do for unallowable costs, right? I've seen procedures organized where there's a separate document for each one. That's fine. You can have one large manual with chapters. That's fine. Just make sure you cover it. Again, that 1408 criteria is a great starting point. Always have roles and responsibilities. I can't tell you how many procedures I've read that say company XYZ will test for unallowable costs every 30 days. Okay, that's fine, good. Who does it, right? It's not the company that does it. Somebody in the company. There's a role that does it. And until you assign that role, it becomes very vague. And it can be questionable in terms of, is there really an internal control here, right? Is it the secretary that's doing it? Is it the guy on the loading dock that's doing it? Is it the CEO that's doing it? Who's actually doing some of this stuff? Always ensure your policies and procedures talk about unallowable costs. Not only how we treat them, right? Do we put them in our 900 series accounts, or do we not segregate them initially, but we test for them later on? There should be a process. There should be training around unallowable costs. Provide examples in your procedures that are of unallowable costs. FAR 31205 has a whole list of expressly unallowable costs that you guys may want to consider when you're looking at your policies and procedures related to unallowable costs. Make sure your business has an ethics policy. That goes to that first criteria in the 7006 clause of internal controls and sound organizational structure, right? Everything tone at the top. If we have a business ethics policy, we talk about gifts, we talk about bribes, we talk about kickbacks. That's going to be important for a purchasing system, not just accounting system. But having a business ethics policy, again, tells the auditors, okay, we've looked at this. Here's what we want our employees to do, or conversely, don't want our employees to do. That's going to help lower some of that audit risk. You'll never eliminate audit risk, but you can always lower it. Don't do things that you don't. Excuse me. Wow, I'm getting tongue tied here. Don't list things that you don't do or don't intend to do. If you say we're going to do biweekly reconciliations from general ledger to our subsidiary project ledgers, but we only do them monthly, don't say we're going to do them biweekly, because they're going to look for them. So everything that's in your policies and procedures should be able to be linked to a transaction or to something that the auditors can test. Drive the narrative. Auditors fear what they don't understand. So when the auditors first show up, prepare a few slides that talk about your business and your practices. If there's things that make your business unique, and all our businesses are unique, right? But if there's things that we do differently that they may not have seen, especially if you're one of those contractors, you may have some contracts with 3-letter agencies or some things that are classified. Obviously, you can't talk to a lot of detail, but let the auditors know that exists. They may not know that, right? Don't assume the auditors know everything about your contract profile and portfolio. Explain to them why they may see certain transactions the way they see them and why they may not see others. If we, for example, if our accounting shop is only 2 people, well, we may not have a lot of segregation of duties, and let them know about that, right? Our accounting department only has 2 people. Here are things where we segregate duties, here's where we don't, and where we don't, here's how we handle it, right? We review those transactions monthly, every 3 months, whatever it is. Deficiencies and corrective action plans. We talked a little bit about that earlier, right? If we know something is wrong, it makes no sense to sweep it under the rug. Odds are the auditors will find it, especially during the audit. Not always during a pre-award survey, but during an audit, odds are they'll find it. But it's not enough to just identify them. Have a corrective action plan, right? Here's what we're going to do to fix it. We identify what our root cause of that problem was. We're going to fix it in 3 months, 2 months, 60 days, whatever it is. And we ourselves are going to retest. We're going to retrain people. We're going to update this policy and procedure. Have all that laid out for them, because again, if it's a big problem, yeah, it may put your accounting system at risk, but again, they're going to find it anyways. It's better to have it up front, self-identified. That way, when the contracting officer picks up the report and company XYZ had a problem here, it was significant, they self-identified it, we reviewed their corrective action plan, we believe it's going to meet the intent of fixing it, they're going to retest in 3 months, we're going to come back and retest in a year or whatever it is. That reads a lot better versus we found all this and it's all messed up. We recommend that the contracting officer, disapprove the system, or we recommend that we, have constant surveillance, things like that. We talked about holding their hand again. I'm going to reiterate it one more time. I can't reiterate it enough. If there's something specific you want the auditors to see, show it to them. I know a lot of people, when you deal with auditors, it's annoying. They come in, they're on site, they ask so many questions. Sometimes you just kind of want to stick it to them. I remember one time when I was an auditor, we went out to a base. We were going to interview the logistics operation on the base. They put us basically in the mechanic shop in between some of the lifts where there were Humvees. It was greasy, it was disgusting. But that was their way of sticking it to us auditors. Well, guess what? We weren't very forgiving for things that we found, right? It's the same way. They're human. We're human. Be nice to your auditors. Push back where it's appropriate. That's certainly fine. But don't just give them boxes of stuff, drop it on the desk, and say, here you go, because they'll dig through everything. They will, and it's gonna make their life harder, and it's on the back end is gonna make your life harder. Be organized, be specific, let them know what you want them to see. And if they have follow-up questions, they can ask follow-up questions. And remember, risks drive audits, right? Each transactional area, each functional area has risks associated with it. Understand those risks. Test specific things, assess, it's part of that self-assessment piece that's in that 7006 clause. And it's a good idea overall, right? Is to assess how are we doing against what we say we're doing. Obviously, it's going to depend on on the size of your organization, whether or not you have a whole, internal audit department or not. But there are things you can test, and it could be on a rotating basis, right? You don't have to test everything at once, but it's a good idea to have a pulse check on how your system's doing, right? One of the easiest things is reviewing your policies and procedures potentially annually for updates based on new regulations, based on changing business practices, based on new contract awards. I can't tell you how many times I've come in to do like a 1408 review, and I pull the accounting manual, and darn thing's 12 years old. Nobody's looked at it. That immediately, throws red flags up, and I'm going to be a lot more diligent. Now, obviously, my report goes to the client, but if I was an auditor, those are huge red flags, huge. So do bite-sized reviews, little reviews here and there. Keep the documentation of what you do. Test specific transactions. Are we billing on time, or are our billings based on allowable costs, things like that. And as that last bullet says, review, reconcile, rinse, and repeat. Okay. Accounting system deficiency findings may come from all around you. So this is an important point, right? I mentioned a little bit earlier that accounting system, there's linkages to purchasing when we're looking at requisitions. There's linkages to estimating system when it comes to, how do we price follow-on work. These are all other business systems that may or may not be applicable to you guys. But there are ways when auditors are looking at those systems, or they may look at how you guys do your incurred cost proposals for those of you that have cost reimbursable or flexibly priced work, right? With, annually, 6 months after our fiscal year end, we have to put a proposal together to settle our final indirect rates. Sometimes those get audited. And if it's the same thing that the auditors are finding that's wrong or questionable, well, they're not auditing our accounting system. But based on that, they may recommend to the contracting officer that there's a problem with your accounting system. So be aware of what you put into your proposals. Be aware of other audits going on. The GAGAS standards, which are the generally accepted government auditing standards, require auditors to basically report on deficiencies that they have come across, even though it may not be specifically related to the audit that they're looking at. And I apologize, my GAGAS references here to 742 and 744 are outdated. It's in chapter 8 now, in one of the revised versions of the yellow book. But you get the gist and the takeaway. There's lots of things that the government looks at that could point right back to your accounting system that on the surface may have nothing to do with the accounting system. They may be looking, for example, at your purchasing system, and they may see there are no authorized requisitions. Well, that's going to put purchasing system at risk, but that's also going to point right back to our accounting system and say, why are there no requisitions here? So be mindful of that. Be aware that it's not just an accounting system audit that may identify deficiencies in your accounting system. So some common deficiencies that are specifically related to the accounting system that we've observed in our work. And again, these are not all inclusive, just to kind of give you a sense. Contractors not making interim or at least monthly determination of cost charged through routine posting to books of account. What does that mean? Well, the criteria in the 1408 and in the 7006 basically says we have to post costs monthly. So, if we're thinking of maybe even an Excel-based accounting system, right? We have a tab for a particular, all our labor costs, and we're aggregating. The expectation is once a month you take that and you post it to your actual project ledger, and you apply your indirect rates to it as well. That you do that monthly. So some contractors aren't very good about doing it monthly. Some do them quarterly. Some wait till the end. Some do 6 months. None of that's acceptable. It has to be done at least monthly, if not more frequently. If you're on a more sophisticated accounting system, like something like a Uninet or a CostPoint or even SAP or some of the other, I mean, some of those post daily or even real time. So you don't have to worry about that. A lot of those systems also have automated reconciliation that they do for you, but contractors still, test those. Failure to properly segregate direct and indirect costs, right? This may not necessarily just be a function of we don't have a separate account for direct travel and a separate account for indirect travel. It may be things are mixing, right? We're putting direct costs in indirect buckets and indirect costs in direct buckets. That's going to be huge. Those are going to be findings and deficiencies. Improper timekeeping. Timekeeping is a challenge. If you were to look at the FAR Part 31-205 when it deals with labor and costs related to personal services, you'll be hard pressed to find timekeeping. Timekeeping is nowhere in the FAR in terms of having like timesheets, right? And I have to be careful when I say that, because a lot of people keep timesheets. That's sort of the expectation. If you have an alternate method, you better darn well be able to support why you're doing it differently, because that's what DCA looks for. But when we're talking about improper timekeeping, thinking things like, employees don't post time on a daily basis. Managers aren't reviewing time. Time isn't approved. Time isn't entered before the labor distribution cycle runs. Things like that. Failure to exclude unallowable costs, right? There's one thing I mentioned earlier in the procedures. Make sure your procedures talk to unallowable costs, but that doesn't necessarily mean that that's sufficient, right? We have to be able to show that we're actually excluding them when we encounter them, or we do some sort of testing. So if you're not doing that, that may result in some deficiencies. And including billings and payments to subcontractors that are not in accordance with terms and conditions of the subcontract or invoice, right? We're passing costs on to the government that are different than what was invoiced to us, or beyond 30 days. So just being careful of what we actually pass through our accounting system for billing. Some consequences of noncompliance, and these are specifically related to the accounting system itself. Obviously, we're not going to be eligible for cost reimbursement contracts. A lot of RFPs have that requirement in them, so we're not going to be as competitive. Of course, our negotiations may become tougher with the government, because if our accounting system is rough, that means our estimating may not be all that accurate or correct. So the government may say, hey, how accurate is this? I think I'm going to give you another haircut here. Increased oversight and management, right? Which, of course, more hassle, more cost, and more people breathing down your neck. If you have the business system clause, which is that DFAR 7005 clause, you may be dealing with dollar withholds, where the government's going to withhold a portion of your billings until you rectify issues. Suspension or disapproval of costs when there's a reason to believe they should be suspended or disapproved. FAR 42302 basically says, if our costs aren't supported, we have reasonable basis to believe it, they're going to throw them out, especially if your accounting system is non-compliant. And of course, coming full circle, right? Our entire first section on adequacy was out of FAR Part 9, where the contracting officer is supposed to determine the contractor's responsibility. And if we have a non-compliant accounting system with deficiencies, guess what? The contracting officer is under no obligation to make that adequacy determination. So cuts both ways, right? Contracting officer is the only one we ever have to convince, but we have to be careful what we say and what we have. Size doesn't matter when it comes to the complying to the accounting system. It's going to be the effort that counts. And I realize we're coming up on time here shortly, so I do want to leave some time on questions. So I'll try and run through these a little bit more.
You have time.
Okay, sounds good. No worries. So, you're going to find the accounting system requirements and cost reimbursable contracts, time and materials, labor hour, incentive type, CAS covered contracts. Will you see them in fixed price and modifications? Maybe. If you're dealing, fixed price negotiated contracts that are over the TINA threshold, right? You're going to have to disclose basically all of the facts that went into your proposal. You're going to have to give your government customers certified cost or pricing data. A lot of that is going to have to be based on adequate accounting procedures. So just be aware that the accounting system is the basis that the government's going to look at your proposal. So even though you may not have specific accounting system criteria, the fact that your estimates are going to be based on that, it's probably good to have and to be compliant with that accounting system criteria. Lack of an approved accounting system is not necessarily going to prevent or limit your ability to compete. So, and this is different than having a disapproved system or one with significant findings. Basically what it says is if your system's never been evaluated, really that shouldn't limit your ability to compete. Some RFPs may require evidence of DCA reviews and audits. Like we mentioned earlier on, that's really out of our hands because DCA will not do a review based on a contractor's requirement. But there are things we can do with that, right? So we want to fully disclose the status of the system. So if it's never been reviewed, we want to make sure that our procedure says our system has never been reviewed. If that's the case, be ready for a review. If we've had maybe a third party look at our system, so we may say, our system's never been reviewed by DCAA, but we had, John Smith and Company, or whatever it is, look at our, they did a 1408 audit, and here's what they found. Here's the criteria. Here's all the evidence. That may go a long way to, maybe supplementing some of that first bullet, and of course may lower DCA's perceived audit risk if they come in to audit it. So be aware of the proposals and the contract types that are going to have the requirement for the contracting officer to make a determination about the accounting system itself. Concern yourself with the material things, and when those things change, you should have the talk with your CO. So what am I talking about here? Really worry about materiality, things that are big. And then when something big changes, have that open communication with your contracting officer. So, for example, when we change our software, right? Maybe we went from a Uninet to a Deltek Cost Point or to an SAP, or we upgraded from QuickBooks. That could be construed as a big change. And big changes may actually, I don't want to use the term that they'll put your accounting system in question, but they may be cause for additional review. But it all depends on how you sort of approach that conversation with the contracting officer. I had a client a few years ago. They went from Deltek GCS to Deltek Cost Point. Their procedures really didn't change. Their accounting structure changed. The software itself changed. Their project structure changed. A lot of things changed, but the core of how they entered data and how they tracked it did not change. They were proactive. They wanted to let the contracting officer and DCA know that, hey, while we had a material change when it comes to the system, nothing really changed in terms of how we do things. What we did for them, and we basically did another 1408 review, but we also reconciled against the old system to show, hey, everything got brought forward correctly. The procedures haven't changed. The procedures still talk to the same things. They updated, the account numbers and all that sort of stuff. And the contracting officer was fine with that because they were proactive, they were upfront, and they made the case that nothing really changed. So keep in mind, there's no expiration date on a system approval. DCA does tend to do things on about a 3-year cycle. But if there are big things that, like I mentioned, if we do a change in software, policies, procedures, our organization shifts, we get bought out or we spin off a company, we award a major subcontract or we lose a major subcontract, or we get other audits that find things. We want to be transparent and open about that. The contracting officer, DCA, they're going to look at all this stuff and say, hey, this is material. We need to come in and look at the stuff again, especially DCA, right? Because they need the work. I think our job collectively, right, is to convince them that that's really not material. It sounds material, but it's really not, because the more that their perceived audit risk goes up, the more likely we're gonna undergo an audit. So if we just say, hey, we upgrade to a new accounting system, just letting you know, there's bells and red lights going off, and they may say, okay, we're gonna come in and look at it. If we say we upgrade to a new accounting system, we still believe it's compliant, here's our checklist, here's all the support that went into the checklist, here's the policies that we updated, here's how we updated them, just kind of let them know and lay out that case. They may say, okay, yeah, you guys still know what you're doing, good to go. So being aware of what that is, and I realize a lot of that is very subjective. You know, there's no guarantees. We're dealing with human beings in terms of what they're gonna do, but we're talking about, right, risk of review. So if there's big things, address them, and if we can lower the perceived risk, then we're going to lower the likelihood of the audit. All right, let's talk takeaways. The type of contract and the clauses that are in there obviously is going to drive the accounting system requirements, right? If we're talking time materials, cost reimbursable, you know, the very basic stuff is it's going to require the contracting officer to make an adequacy determination. They may not use that 1408 criteria, which is acceptable, which is quote unquote the acceptability. That's my third bullet there. Acceptability is driven by 1408 and the 18 DFARS criteria. So for an acceptable, right, for the pre-award survey, we're looking at the design. Have we designed our accounting system to meet that criteria? If we're dealing with an audit, which is usually going to be against those 18 DFARS criteria, they're going to be looking at the actual operating effectiveness. Approval is when the CEO gives us a written determination on whether it's adequate, acceptable, or approval. That's what means that our system is approved. Nothing else beyond that is quote unquote approved, and it's going to be reflected in CBAR as approved, regardless if the letter says adequate, acceptable. DCAA, especially if you're dealing with DoD, is likely the key advisor to the contracting officer, and contracting officers love to rely on DCAA. So they're usually the ones that are going to be looking at the system. However, contracting officers have accepted third-party reviews and assessments. I mentioned earlier NASA is one that allows third-party reviews and assessments. So consider that if your system has never been evaluated, or it's been 5-6 years since it's been looked at, or we're pursuing large new work, consider looking at your 1408 criteria, or maybe even the 18 DFARS criteria. Again, you can still do a design review against it. You don't have to do a full-blown audit. We've had clients come to us ahead of a DCA audit, right? DCA will announce, they're coming in 60 days. We'll go in, we'll take a look at the criteria. We'll let them know what's wrong right away, from a design perspective, without doing much testing. So consider your options there. Realize that the accounting system is much more than an IT software package. It's that whole cycle, that manifestation of your business process. Keep in mind, process, people, technology, right? Combination of all those is what's going to be your accounting system, right? You don't buy that something that's acceptable, approved, or adequate right out of the box. It's how you implement, how you overlay that against your business system. Know your system, right? I know what's solid, what's less than solid. Understand where the risks are. Drive the narrative with your auditors. Lower their perceived audit risk. When you provide evidence, make sure you annotate. You hold the auditor's hands, and again, be proactive. If there's something that we know is wrong, let's be cognizant of that. Let's get in front of that, and understand that audits or reviews may impact the accounting system from various different places. All right, I think that gets us to questions, concerns. I know we have a few minutes here. Happy to take anything offline that anyone may have, but let me know what you guys think. I hopefully this was useful. Hopefully it's applicable to what you guys may be dealing with, and gave you some hacks and some ideas that you may not have thought of initially. So thank you.
Okay. So again, this presentation, this recording, and the slides will be sent to everybody on Friday. So we will get busy getting this stuff to you. So we're waiting for now. If anybody have any questions, so we're gonna give people a couple minutes to form them, and then I'll read them off. Alex, this is great. I'm telling you, I was having flashbacks of my accounting class. As you could tell, I was pulling my hair out 20 years ago. This is why I'm bald now. So this was easy.
Well, my wife tells me that the CPA doesn't stand for certified public accountant, stands for certified pain in the what. Yeah. That's how we feel about auditors.
Yeah. So, do you have any questions? Checking out the chat.
I don't see anything in the chat.
No, I didn't see any questions either. Everybody is soaking all this information in right now. So I think they're gonna be reviewing to get this video again. And you have Alex's information to send him any questions that you have.
Yeah, please feel free to reach out. Happy to chat through anything you guys have, give you guys ideas. I know, some of this business of dealing business with the government can be pretty daunting. Some of the compliance requirements are challenging, to say the least. But there's ways, there's solutions to almost everything. So think about it, formulate your questions, let me know. Happy to chat with anyone.
Okay. Look like there's no questions from anybody. So again, we'll get this out to you by Friday. Alex, thank you so much for doing this for us. We invite you back for Charlie Mike. I know you're taking that offer. So until then, but next week, we will have Charlie Mike on Thursday instead of Tuesday. And that's how to use our new system, Vet Connects. So until then, thank you. Stay cool. I know it's hot outside. It's beginning of summer today. So, and it's been hot the last couple of days. So stay cool and enjoy your weekend. And I will see you guys next Thursday. Take care.
Take care, everyone.